You could have a view on that. But we're talking about elections, we're talking about markets, and we're talking about companies. Cholamandalam Finance posted a strong Q4 with asset quality improving and profit beating estimates. Lower slippages and credit costs lifted earnings, while disbursements stayed robust across segments. We're speaking to the management. Hiral is joining us for more.
Thanks for that. Exactly. Cholamandalam Finance has actually reported a robust performance in the fourth quarter, with consolidated profit jumping approximately 30% on a year-on-year basis. In fact, if you talk about the quarter, it was marked by a strong, broad-based disbursement growth, and you did see improvement in asset quality as well. There was healthy growth in terms of AUM across segments. And if you talk about the disbursement growth, that was mainly led by vehicle finance and the new businesses that did come in. In fact, the operating profit growth was on the back of strong NI and fee income. Profitability absolutely beat estimates, and the net interest margins expanded on lower funding cost. To talk to us about more on what FY27 has in store, Arul Selvan, Chief Financial Officer at Cholamandalam Investment and Finance, joins in. Mr. Selvan, welcome to the show. Always a pleasure to speak to you at NDTV Profit. My first question coming to you is, overall, if you have to talk about FY26, we've seen an AUM growth of around 21% that has come in here. How are you looking at FY27 from here on? Are you seeing a good improvement, or do you think it could be slightly subdued with what's happening around?
Morning. We expect to repeat a similar or even a better performance in FY27. But we keep our AUM growth in the range of 20 to 23% as we had always kept in the in the earlier sessions also. So we are targeting to grow the AUM by 20 to 23% in FY27.
Okay, so what segments will drive this growth? Will it be home loans, LAP, or SME? Because maintaining pace is going to be important now.
See, what we are seeing in Q4 is most of our business lines, which is diversified across various products, have started, showing good amount of traction in growth. So we expect this to happen. Vehicle finance will also grow. The new businesses will grow. Gold will grow. LAP and HL will grow, the mortgage businesses. So all this is expected to show a good amount of growth in the coming year. So we expect the growth to be, coming across all the business lines.
Okay. And are you seeing any concerns in any segments which could probably be on your watch list for FY27 that, okay, these are segments where there could be a potential slip? Which would they be?
See, in case the global risks escalate, and then there are issues with regard to supply side and especially with regard to fertilizers or other commodities which needs to get transported, slows down, then there could be a slowdown in the requirements for vehicles, and so there could be a slowdown in the vehicle demand. But as you know, and we're seeing a large effort to de-escalate the situation, and hopefully this will get de-escalated. Thankfully, this is coinciding with Q1, Q2, where generally the first 2 quarters in any financial year for vehicle finance would be a little slower growth as compared to the third and fourth quarter. So I'm sure by the end of H1, most of these would be behind us, and we should see the growth coming in once the festival starts.
Okay, so festivities is something that we should be watching out for. Overall, in terms of disbursements as well, a growth of 25% in the fourth quarter. Will you be able to maintain similar levels in the coming quarters as well?
The Q1 will be a muted quarter always. This is across various businesses also. So Q1 you will see a little amount of drop in the disbursements. But AUM growth would still sustain, because last year Q1 was a dull quarter. So we can, I'm sure we'll do better than last year Q1. And so we should see improvement over Q1, but it will not be certainly an improvement over Q4 of FY26. So to that extent, you will see a slowdown. But I think that is part and parcel of the seasonality that we go through across our various products.
Okay. The other interesting aspect is when you talk about, the net interest margins and the credit costs. Now, What is that number going to look like if you have to look at FY27?
See, FY27, we are right now projecting that the NIMs should hold at the year level. Like if you look at it and the overall year, we did around 8%. We should hold it at that. My hypothesis is based on the fact that the newer businesses will grow faster, which have got a higher yield. And so their contribution to the NIM will be marginally better. So that should offset even in case there is a slight increase in the cost of funds that may come up in the second half of this year. So overall, we expect to hold the NIM, and credit costs could be marginally higher in the new businesses, but as a whole, they are not a large proportion. So for that to influence the overall credit cost would not be significant. But we should show a lower credit cost, especially considering the management only we considered last year, that is in FY26. As compared to that, we should target around 1.5% credit cost overall.
Okay. And when you're talking about stage 3 assets, how has it been in the fourth quarter? And if you have to look at, the actual recoveries versus the rundown of the fintech lending portfolio, where does that stand?
The fintech lending portfolio has run off most of it, so we should see an improvement. A part of that improvement is reflected in the Q4 results itself with regard to stage 3. Stage 3 had improved considerably as compared to Q3, though it is slightly higher than Q4 of last year. But however, if you see the stage 2, it is lesser than last year's Q4 itself as well as the Q3 of this year. So that is the, sort of a pre-indicator of the upcoming stage 3 in the coming quarters, and that should therefore be auguring well to keep our stage 3 well in control. In Q1, these two numbers may go up again. This is again the seasonality factor I spoke earlier. So these two will move up as compared to the Q4 numbers, but they will be certainly lower than last year, as well as we will end the year at a much better numbers as compared to current year.
Okay. And in terms of where ROAs and ROEs go, where do you look at, maintaining them in terms of FY27? Because if I'm not mistaken, 3.5% has been your target for FY27. Do you still stick with that? And what specific levers, say, may it be mix change or lower credit costs, or, these will be the most critical to reaching this kind of a target in the next 12 months?
See, that's where when I said credit costs at 1.5% and holding NIMs at the same level, obviously that would directly give me the 3.5% ROA pre-tax for the current for the FY27, because and we will hold OPEX at similar levels. So there is also a possibility OPEX can be brought on a bit more to the targeted levels of 3%, which would improve it further. But right now, I wouldn't want to commit. Our target remains at 3.5% pre-tax ROA for FY27.
Okay. And my last question, Mr. Selvan, is in terms of the recent conversions of CCDs. Now, the Tier 1 ratio stands at around 14.5%. That's the kind of range. Is there any requirement for fresh equity infusion in FY27 to support the kind of growth that you're looking to achieve?
See, we keep constantly evaluating the requirement. As earlier reiterated, our internal threshold is 13% on Tier 1. If we cross that threshold, we will certainly seek capital. But we will also look at opportunities in the market and take a view on whether to come a little earlier on this. But right now, I'm not able to comment about this, as we need to evaluate the growth opportunities as well as our capital requirements, and then take a call on it in consultation with board and other senior people.
Okay, so that was Chola Finance. Let's talk about 4% up and in focus. We were talking about the FMCG space, and Nestle has seen